Hi. So this was last where we left our CAPM, that is capital asset pricing model. So can you tell me what was the thumb rule? Just a bit of recap from previous class. So if
Okay,
I if I had to decide which security is overvalued and which security is undervalued, what is the rule for that? So if I tell you that, say, CAPM gives you, say, some returns and analyst gives you some return, and likewise for undervalue also there is some relation. So what is the relation for overvalued and what is the relation for undervalued between CAPM estimated returns and analyst estimated returns? If you just to recollect, if not, I'll tell you. No problem with that.
okay. Um,
Just
what I know
remember,
about,
yeah,
pardon?
just remember that CAPM also always dominates. So, I mean, the decision criteria would be based on CAPM. So, just a hint if you want to answer. Otherwise, I'll answer it.
Okay. Um, what I can remember about CAPM is that it's a capital asset pricing model
Yeah,
that we are using to assess the investor's required rate of return
yeah,
given the market risk.
yeah. That's correct. Beta, that we talked about beta in last session. So, see, my point was, if your CAPM say that your expected returns are 8%, and as per analyst who estimates the return based on, say, cash flow models, like over where we have dividend, we will solve the one numerical based on this. So this is a foundation to solve this kind of question. So say 8% is by CAPM and analyst says say 6%. So in this case, CAPM is telling you that the security, I mean, you can expect 8% returns from this security, and analyst says that it's 6%. So ideally, CAPM dominates. As per CAPM, it's greater, so it is overvalued. So for a I mean, for overvalued security, returns estimated from CAPM are greater than what analyst estimates. Likewise, for undervalued security, returns estimated from CAPM are less than, uh, say this is 8%, this perhaps would be 10%. So return estimated by CAPM would be less than what analyst estimates. Does it make sense?
Yeah, it does, but I want to understand the rationale behind that.
Rationale is like, as you mentioned, that CAPM is like more realistic. It incorporates the market risk, that is beta. Whereas what analyst estimate is, it's based on just the expected dividends, expected cash flows. So somewhere it's like expected or forecasted. Whereas CAPM is more like you're taking real information from live data of the stock price. You're coming up with beta and you are using that to estimate the returns. So this is more realistic. That's why it has more weightage when we are deciding. So if CAPM says that higher returns are expected, we say that it's overvalued and should be sold, and the other way around also. Does it make sense? Does it
Okay.
on? Yeah.
Yeah, that makes sense. But I still don't understand if I can get the difference between overvalued and undervalued to say, all right, I now understand that if CAPM return is greater than analyst
Mm,
return, that stock is overvalued. Meaning, when we say it's overvalued, are
mm.
we saying we have to sell it because the price is going to drop?
Yes, that's correct. That's correct.
Okay, because we are saying the returns, all the return assets returns in the market should lie on the CAPM line, like SLM line, security market line. So that's
Mm,
why we are saying we should sell it so much that when the price drops,
yeah,
we'll have made profit.
that's correct. Yeah.
All right, now I see.
Yeah. So that's the decision criteria overvalued as in as you said that we expecting the price to be dropped. So that's why we sell the security. And for this one, it is cheaper. So we try to whatever we go to market, we find something cheaper, we buy it because we expect that price of that to go up. So as you mentioned, so that's the overvalued and undervalued. This is a decision rule to decide which security is overvalued and which security is undervalued. Okay. So now let's see one numerical based on this. So you are given three stocks. Stocks. Just give me a moment. Yeah. The stock A, B, and C, and this is the price today. And this is the expected price today. This is basically this information has been given to you to calculate what analyst will calculate. So this is estimation price in 1 year and expected dividend in 1 year. And this is a beta. Beta you will use to calculate CAPM returns. So the
Yes,
basically what you need to do, there are two steps. One, you will calculate CAPM returns. Number two would be you will calculate analyst return, and you will compare both, and you will have to decide which is overvalued and which is undervalued. This is a question mark. So for all three stocks, you have to decide which one is overvalued and which one is undervalued. Is question clear to you?
yes, the question is clear.
Yeah. So I just gave you the information from table, but yeah, analyst wants to focus three stocks. He has based his analysis on the following. So you have been given risk-free rate, you have been given market return, and beta is available. So we can always calculate CAPM. And
Yeah,
likewise, we have other information for which we can calculate analyst return and we can decide. So let's do it. Let me just switch back to mouse. So let me call this as A, B, and C. I'm performing it in Excel. I mean, if you want, I can write it down like how I wrote for this decision rule. But yeah, I think I can perform calculation in cell itself. I mean, it's just a simple multiplication and addition. You can just do it in your piece of paper. That will help, I think. Yeah. So in this column S, let me calculate CAPM result, and let me do it little below so that I have some space. So over here, what I'll do, I'll calculate analyst return. Okay. And over here, we'll take decision. Okay. Can you tell me how, what is the returns as per CAPM? I think last time we covered this CAPM returns. So what are returns
okay.
as, yeah,
Okay, it's RF, which is risk-free rate, plus beta times market return, which is RM minus RF, which is risk-free rate.
perfect. Yeah. So I'll apply the same equation in these three cells. So as you said, risk-free rate we have been given is 8%. So I'll just do 8% plus beta. So for stock A, let me just write respective betas over here. So for stock A, it's 0.1 and zero point 0.8 point. Can you just one question, interesting one, just to make your understanding more stronger. Looking at this, looking at these beta, can you tell me expected return for which stock would be higher if I just compare this CAPM return between ABC? Of course, see, the final objective is to compare these two returns, but just additional question. If I were to compare CAPM return between ABC, whose betas are these? Can you tell me for which stock the CAPM returns would be higher?
Stock C,
Yes, correct. Why?
because the risk of that stock compared to the market
Perfect.
is high.
Yeah, beta is higher, so it has a higher market risk. That's why the investor would expect higher returns to take, to take that risk. So that's the correct answer for this is stock C amongst ABC, which will have the higher return from CAPM. Now let's calculate. So it is risk-free rate, that is 8%. Let me just circle it so that you have focus on this. So these are the two information that we will use.
Yes, we have the difference between the two, which is 8% market risk and risk-free rate. It's risk premium, right?
Yeah.
So it's the same for all the assets.
Yeah. Just give me a minute.
So we'll just multiply that by beta of each asset and then add the risk-free rate.
Yeah. So let
And
me give me a moment. Yeah. So it's 8%, as you said, percent risk-free rate plus this is beta times what? It's
we
RM.
multiply by beta, not add beta. Then we add whatever the results, we add 8%, which is risk-free rate.
Yeah, Excel will take care of it. So there is a rule called BODMAS. So what that will do, it will multiply these. So I will it's like RM minus RF. So your market return is 16%. 16
16%,
per
yes.
minus 8%. That is your risk-free rate. So this bracket term is called as a risk premium. That means how much investor is expecting to invest in the risky asset. So this difference is that, and like risk on that is beta. So it will get multiplied and it will get added. So this is something which you would expect. And likewise, it can be calculated for these three stocks. And as we expected that returns for this stock would be higher because beta is higher, and we can see that over here. And now for analyst, see, can you tell me what is a return, normal return when you?
The normal return of the
Yeah,
analyst.
yeah. So when you say for example you invest at 100, you get 110. Simple example. So how you calculate the return? It's 10%. But how we
10%.
mathematically calculate is 110 minus 100, and this 10 is earned over the initial investment of 100. That's how we get 10%. 10 over 100, that is 10%. Okay.
Yes,
So in a similar way, this is your initial price and this is your final price. But in between, you are expecting dividend of 1. So what happens that if there are dividends, usually your price goes down, stock price goes down. So this one has to be subtracted from this final stock price. That's the only change. This is a very general example that I gave you. But if I were to write for this example, my return would be or expected return, or it would be final price minus initial price minus any dividends received in this, because what happens actually your final price comes down approximately by amount of dividend that is received on the stock. So final price would be somewhere around 27 if there is a dividend of $1 in between. So your initial price was $26. It's initial price over here. So we will apply this equation to calculate the what is the returns estimated by analyst. So if I apply the same equation, let me write final prices somewhere. Let me write over here. The final price is 26, 46, and 18. And initial price over here is 26, 40, and 16. And somewhere dividend 1, 2, and sorry, 1, 2, and 0.83. And now what I'll do, can you tell me, can you help me? How do I calculate this? Just to bring your
okay.
attention on this. Yeah. Let me write
I think we
this.
will say 28 less 26 less 1.
So 28 minus 26 minus 1 divided by,
over
yeah, over
over 26.
Perfect. Yeah. So this is a return, and it's same for all. Surprising. I think I did mistake. Ideally, I should apply formula. So
Yes.
yeah, final minus initial minus dividend over your initial investment.
Initial, yes.
3%. So these are your returns, but I doubt if something is going wrong. In all cases, as returns are lesser. No, I think not.
Yeah,
Yeah.
that's the
Can you
correct
can you
answer.
can you tell me how do we decide? But
Pardon?
just give me a moment. Just I think there is some issue because I was wondering that how returns can be so different than what CAPM is given. So slight correction over here for this one. For this one, actually, what happens? Your dividend is kind of a inflow to you. Being an investor, you receive your dividend. Of course, stock
Dividend.
price will go down, so it will be factored in this final price. Of course, just different ways of representing. But over here, we'll add dividend to your final price because this cash flow will be received by you only and minus initial price. So just disregard this formula and apply this one because
All
I was
right.
wondering that how different the returns can be so different than
So the formula that you're talking about is a holding period formula.
yeah, that's correct.
Okay, all right.
So your final price plus your dividend price minus your initial investment
Yes.
divide by your initial investment. Okay, so this is what you will analyst is estimating. So now you tell me
You said what is the reason of adding dividends?
dividend is because see what happens if you have bought the stock and board declares some dividend, it will be received by you. So it would be eventually it would be a cash flow to you in event.
Yes.
So it's a gain for you. So whatever say you invested 26 and your final stock price is 28 or 28, but you receive the stock $1 dividend also. So it is also kind of a gain. So your final price, final gain would be increased by your dividend amount. Does it
Yes.
make sense?
Yes. Yeah, it makes sense.
Okay, cool. So this is what we have got dividend. Now you have to help me using this rule. Now tell me which stock is overvalued and which stock is undervalued. Now this you have to tell me. Yeah.
Okay. For stock A, because CAPM is more than the analyst prediction,
So this would
uh,
be
is overvalued.
overvalued. Perfect. And this one,
Okay. And that one will be undervalued because the analyst return is more than the CAPM. So it's going to
perfect,
be undervalued.
perfect. And for last one,
It's very close. So the
very close,
prediction,
but still
yeah, very close. So I'm not that one will lie on the CAPM.
it's near to that. But yeah, I mean we can still see that it's 17.6 and this is 17.69. So still CAPM
Yeah.
is higher. But if I go strictly as per thumb rule, we can
No,
flag
the
this here.
CAPM is lower. The
Yeah.
CAPM is lower.
So this is something, what our decision, final decision is. And and what you do with undervalued and overvalued stock. So one
All
that,
right.
yeah,
The overvalued we're gonna buy because we are expecting the prices to go overvalued.
mm,
Yeah, for overvalued we're gonna buy because We are
Overvalued.
expecting the price to go up.
Say, for example, if you go to a shop, say to buy clothes, okay, and if
Yes.
something is expensive, will you buy?
Yeah.
You will buy
No, I
expensive.
don't buy.
So expensive things are
No, I won't buy.
expensive
No,
things are not bought; those are sold. If you say if you
they are sold.
yeah, so overvalued stock over here, a stock would be sold.
Yeah, that one will be sold.
Yeah, and the other things that are undervalued, a thing which you can buy cheaper, you always tend to buy.
Okay. The
Yeah,
undervalued one. All right. Yeah, the undervalued we always buy, and the overvalued we also will always sell.
sell. Perfect. So stock A,
Okay.
we will sell. Let me write it over here, something over here like A, B, and C. Sell this, buy, and buy. Does it make sense? Does it?
Yeah, it does.
And so, which option is correct from the out of these four options? It's like you're from your FRM level one, that is Foundation of Risk Management. So,
Okay.
which option will you choose if you were to choose? Are all three overvalued?
D,
No.
D because D we have A overvalued, B, C undervalued. So
Perfect.
I'll choose D.
Yeah, this is not correct. And A is undervalued, it's not correct. So, you perfectly spotted, it's D.
Yes, it's D.
Is it clear now? Very much clear
Yeah,
because
it's
I think we
clear.
solved numerical also now.
Yeah, this is very clear.
Okay. And this is a pictorial representation, I think, that we saw on that day. Yeah. So whatever is uh, CAPM is this blue line, that is yeah, SML, security market line. And
Yes,
so something which is, this is analyst that is predicting B. So this is Uh, so analyst is predicting lower, CAPM is predicting higher. So CAPM is higher, that's why this stock is overvalued.
overvalued.
Similarly, over here, analyst is predicting A, but SML is predicting here. So this is lower as compared to what analyst is predicting. So SML is lower, it would be undervalued. This is a pictorial representation of the same thing that we saw.
All right.
Yeah.
Yeah, I think I now understand.
Okay. Anything else you want me to cover? So just one difference for SML, your X coordinate is beta. Can you tell me what is your SML for capital market line? This,
Capital market line
yeah,
is supposed to be standard deviation, I think.
perfect. Yeah, that's correct. Standard deviation. So that's for capital market line. For SML, it's beta.
Okay.
Yeah. And yeah, I think this was about CAPM. We can demonstrate using some practical data, perhaps when we'll be connecting next time. So this was for beta. We can explore like sha-
Okay. Can you please explain the difference between the two lines? Meaning, the capital market line is the relationship, shows the relationship between expected return and risk, which is standard deviation.
that is for capital market line. SML
Yeah,
calculates your beta, that is market risk.
your beta.
Yeah. So
Okay.
when you're
Meaning
studying, yeah, go
pardon,
on.
for systematic risk, we use the SLM. To measure systematic risk, we can use SLM, and to measure idiosyncratic risk, we use capital market line.
Perfect. That's correct. Yeah, absolutely.
All right. Okay.
Okay. And ratio corresponds to this is one. Can you tell me which one for SML? So for SML, which is a ratio?
Ratio of what?
Say, I think you studied in your foundation Sharpe ratio, Treynor ratio. Do you remember?
Yes.
So these are basically to measure your risk and return profile. Okay.
Yes.
So what was the Sharpe ratio? Let me just write SR as a abbreviation.
Okay. It was Sharpe ratio should be RP
So your
minus
portfolio,
RF.
yeah, portfolio return, what your portfolio is generating over and above risk-free rate.
Yeah, I think I think it is supposed to be over beta of the portfolio, unless
Uh,
I confuse the two.
yeah, I think, yeah, you're
Because
confused.
the other one is standard deviation and the other one
Yeah.
should be over
So,
beta.
yeah, for sharp one, it's sigma. For Treynor, it's your beta. So for
All right.
beta is your market risk one. We can, I think, continue this next time if you want to explore more. But yeah, this is basically is a ratio that tells you for per unit of risk. So in denominator of both, there is a risk. Over here, it's market risk, and over here, it's a portfolio risk. Like how much your portfolio is dispersed, your standard I mean, or you can imagine this as a idiosyncratic risk that you mentioned. But yeah, both ratios tell you what is a additional 1 unit of additional. So say for example, if I say my Sharpe ratio is 1% or say 3%. Okay, so this Sharpe ratio tell you that if you increase your risk by 1%, your returns would increase by 3%. So for per unit of risk, what is the price of this risk? That additional risk that you're taking, what is the additional return of earning that you're getting for taking that additional risk? In a similar way, someone can argue for beta also. Does it make sense?
Yeah, it does. So I want to understand, meaning Sharpe ratio is the slope of the CML
Correct.
line,
Yeah,
and Treynor is the slope of the capital market line, SLM, SML, which is security market line.
that's correct. Yeah.
All right. So both of them do measure the increase in the rate return in the required rate of return as the risk, being it systematical risk or company related, which is idiosyncratic risk.
Yeah, like, yeah, that's correct.
Uh,
So
or
company related, you can think of any management issues or any labor strike.
strike,
These are
strike.
idiosyncratic risk. Strike, like if laborers are not happy, if they're not getting good increment, they may say that they don't want to work for a certain time period unless they get increment. So those kind of issues are very specific to those companies. Whereas if I talk about increase in interest rate. So that is kind of a market risk that would be captured in beta. And initial problems that I talked about would be captured under the standard deviation. Like your management is like CEO is not responsible, etc. Anything which is very specific to that company would be measured by your standard deviation. Anything which is a very market specific, say rate of interest, repo rate, or any your central bank is increasing or decreasing rate, those kind of stuff would be factored in beta.
All right. So how do we find the expected return using the capital market line? Because like for SML, we use the CAPM. What do we
Mm,
use for the company specific risk required rate of return, which is related to the company specific risk?
mm.
What
So
is the formula for that?
yeah, it's simple. You can also tell me. So over here it's SML. You can derive for CML if you want to calculate expected return for CML. You can tell me. I mean, there are only few changes. Only slope will change. So
All right, meaning for beta, we will have standard deviation.
uh not really standard deviation, because what happens that over here is like beta of stock divided by beta of market. Okay, so this is actual equation. But because beta of market is always one, that's why we don't write this beta market. So in
Oh,
this,
I see. Because
yeah,
it's always one.
yeah, that's correct. So in this case, how it would look like is your risk-free rate plus this additional component would be there, this RP minus RF. Okay. But over here, now your standard deviation would be both, like this slope is of, so I mean, you have to consider both your market standard deviation as well as your stock standard deviation. So it would be your sigma I and sigma market, if I'm not mistaken, between these two, because market, yeah. So you can just see that this Sharpe ratio, if I just shift this sigma M below this RP minus RF, this is your sigma M. So this is your slope, and this is a general equation of line. This is like C plus mx, or x, that is your standard deviation of your stock, and like over here it's like Sharpe ratio of the market. Does it make sense?
Yeah, it does.
So this is how this equation is derived for your uh, capital market line also.
All right, okay. I now get the difference.
Yeah, good. So this is how the equation, in fact, yeah, these are SML, CML. We can talk a lot more on this by taking some, you can just bring to one stock, let's say any exchange in your country. Just try to get one stock. We can get the data of that from Yahoo Finance, and any index that is market. We can just get data, just analyze more on these areas also. So we can explore on that.
All right, okay.
Yeah. And just one liner feedback. How did you find the class?
The class was very helpful.
Okay.
Yes, I really appreciate it because I now understand the difference between capital market line and the security market line. And I thought I, I've been thinking that it's the same thing, but now I can see the difference. And now I understand also the difference between underpriced stock and overpriced stock.
Yeah, that's why we say we always try to stimulate the thought process of the students. Yeah.
Okay, thank you
Mo-
very much.
Most welcome. And yeah, just study this, just watch this recording. And if there are any doubts, we'll be happy to take on this.
All right, okay.
Yeah. Yeah. Have a nice evening.
Thank you very much.
Most welcome. Have a
Enjoy
nice evening.
your weekend. It's Friday in South Africa.
Yeah, it's yeah, I mean, it's same here. So you too have a nice weekend. If you want any
All
sessions,
right, okay.
and
Thank you
ask your
very much.
colleagues to subscribe to our channel. I know that you mentioned that they were finding the recordings very helpful over YouTube channel. So
Yes.
please do ask them to subscribe to channel, and comment if there are any doubts. We will reply on YouTube itself, or we can take it via you also. Either ways, we should be good.
Okay, I will definitely do that.
Yeah. Have a nice weekend and have a
Thank
nice evening. Take care. Bye.
thank you very much. Bye bye.